Good morning, everyone. Welcome to this analysis to action webinar as a part of ProMT Club Live. This is Rishi Umrania here. I use the name ProAMT Raider at various all social media platforms, and this name is nothing. I'm not a pro, but it just means that profile AMT and trader. So I just named it like this. Let me go through the disclaimer first. Trading in stocks derivatives involves substantial risk of loss and not suitable for all investors. Past or simulated performance is not a guarantee of future results. All indicators, strategies shown in the video are for education purpose only. All levels discussed in this video are for understanding the study and not a recommendation to trade. Please consult your personal financial advisor before making any trade decision based on this video. We will not be responsible for any resulting profits or losses. So what we'll do is wait for 5 minutes till everyone joins in, because seems like the seats were full, and till now only 33 people have joined. So we'll wait for 5-10 minutes, and otherwise we'll continue. So a brief introduction about myself. Back in 2009, I actually met with an accident, and that is what led to all this. Otherwise, I would have never entered into trading. Now, the condition was that I might have to, because I work in the film industry, and it involves rigorous field work. So it's like standing on the set for 12 hours at a stretch, at times goes up to 18 hours a day. And the leg was in a condition that if it doesn't get okay in a year or two, I might have to think for another profession. And how this came to my mind is, after passing school, me and one of my friends, that time it was that Harshad Mehta's boom, and everyone you meet is making money in the stock markets. Wherever you go, you will see people would have bought stocks just 2 days back, and they've gone 20% up, 30% up. Those days there was no circuit, so it can move anywhere. So now that I thought this is the best thing to do, because then you can just buy and sell stocks and make money. So all that I thought in the school, that I wanted to pursue mechanical engineering. So that was that thought was fading a bit. That I thought that if I become a mechanical engineer, the max money I could make would not be what I could make in the stock market. So we started trading, and with zero knowledge. I didn't even know what is debit and credit, and what is a stock. But we started trading because there was a newsletter called Blue Chip. So they would recommend 4-5 stocks. It was a fortnightly magazine, I think, and they would recommend 4-5 stocks. We would buy them, and luckily, if not all, few would have gone up 20-30% already in those 14 days. So by the time this goes up, we exit that and again buy another. Now this went on for a few months, and all of a sudden that market crash happened, and now, as of now, most of the holdings are delisted. Now this was completely a shock, because we never thought that will happen. Now, I can recollect that if at that time I would have invested in few good stocks. Now, good stocks cannot be defined, because if we are defining good stocks as higher market cap and zero debt and such parameters, that is the now. We don't know after 2 years or after a year what is going to happen. So in hindsight, it looks very nice that if I would have invested in good stocks today, the returns would be like multi-bagger returns. Few stocks have gone more than 500x as well. And that rosy picture actually lures you to the market, because when you see such things happening, you think, okay, let's also try. Maybe my luck will work. And then slowly as the losses come, attribute those losses to luck, or attribute those losses to an advisor, or attribute the losses to XYZ, but never take the blame on yourself, because the moment we take the blame on ourselves, we will start to improve. And we'll find ways to improve, because if there is a mistake, if we were doing a business and suppose we are running a restaurant, and the people complain that we do not serve good food, the food is stale, instantly you will tell the chef that, okay, there is a complaint from the customer, and from tomorrow this thing should not happen. So that time we are ever willing to act, because we consider that as a business. But the moment it comes to stock market, no, we change our behavior. That time we want to complain for each and everything, but not ourselves. So then later in 2009, I just wanted to look back that what was the reason for all those losses? Where did I go wrong? And in the due course of finding where did I go wrong, I came into contact with Digvijay Singh Jadeja and started with learning the basics of technical analysis. Now this guy is now a friend. That time he was a unknown person and just a friend of a friend. And he was a sub-broker for Religare. And generally you won't find sub-brokers having a very good skill of technical analysis, very good knowledge, and knowing in and out of the stock market. That rarely happens, because generally you would see sub-brokers are more lean towards generating their brokerage rather than teaching us anything. So I was lucky enough, this guy told me that this is not how you trade. If you want to invest or trade, you should know the basics, at least how the market functions. And before that, I thought that the market functions on fundamentals, and if the results are good, the stock might go up. Results are bad, the stock might fall. But had never heard about technical analysis. So when he showed me the chart, he said that this is OHLC, this is the volume pain, these are the basic indicators, RSI, MACD and stochastic. He showed me how to use them. Now I didn't understand anything, but that urge to trade. So I opened an account and started trading directly. Now what I used to think is, he had shown me that how the market falls with volume, how it rises with volume. Now it didn't fit in my mind. What I started doing is, when the candlesticks are coming down, generally you would see they are red colored, but in AMI Broker you can adjust them. So they are like your outer outline would be red, and inside you can make it a bit pale red or pink or brown, whatever shade you want to give. So what I used to think is, the market is coming down, generating volume there. Now the volume pain was not existent at all, but I was thinking that it is doing like that, so this market will go up very fast. So kept on buying as it is falling, and ended up in losses again. So I used to tell him every day that I'm doing exactly what you have said, but I'm not making profits. And he never used to reply anything. He said, okay, slowly you will make profits, slowly you will make profits, but no other reply. And I thought, I'm gone. Again, this capital will be gone. Later, he told me that I was doing completely opposite to what he had said. And then he explained everything. What is RSI? What is MACD? He said, till you don't understand that, it's pointless to just watch the charts. Everyone can watch the charts. So finally, in a year, I got that basic understanding and started trading. And that time it was not a intraday affair. It was like every few days I would trade and be in the trade for a few days, because I had to go for shoots and cannot afford to do intraday trading. But even after a year, I could barely recover the losses. So making losses was easier, but could barely recover all of them. So then I thought that, okay, let's now have started understanding. So let's find something. So something means a holy grail, obviously. Because if what I'm doing is not working, then I have to find something which is working. And something which is working means you go to forums and you would see all of a sudden, okay, 3-line break system is the best. Okay, now start learning that. And then you would see, okay, market profile. Market profile gives you precise levels where to buy, where to sell. Okay, let's learn market profile. Then you would see somebody saying that order flow is the best. That is the real-time market generated information. If a 10 lakh buyer comes, market will go up. Okay, let's learn order flow. So now this your learning would never end, and it should not end, but not in this manner that you start finding a new tool every other day, because the tools you are currently using, you are not using them optimally. That should not be the reason to find a new tool. But for me, that was the reason, because I was not using the existing tool optimally. So I had to find something new. Now in that, I started searching various forums, and then finally it was a long journey. Started with price action, Ichimoku Cloud, EMA, SMA, RSI, MACD, stochastic, CCI, went through all the indicators. Then finally ended up at Just Nifty, Ilango sir as everyone calls him. So I thought that, okay, this is a good system, mechanical, can be done with a Excel sheet. So started doing swing trades. So till JNSR was positive, stay long, and when it goes negative, stay short. And it was quite impressive, but still I could not apply it how it should be applied. Then slowly started learning market profile, with a bumpy ride with lot of confusion. Now in those days, whichever forum you go to, basically it was TraderG and Indie Traders, TraderG were famous in India. And that time I didn't even know about foreign forums. Now Indie Traders was all about market profile actually. So there I found that AFL which Milind and Kaka had made. So I said, okay, now we don't need to invest in softwares also. We can have the AFL in AMI Broker. And this system looks promising. So buy above VH, sell below VL, and buy above POC, keep a stop loss of VL. Sell below POC, keep a stop loss of VH, and so on. Now in a trending market, what happens is the market opens above the VH and starts to rally higher. So obviously that day buy above VH will work very nicely. You don't need to worry, your POC will never be seen. But if the market starts rotating, you will be hitting stop loss almost every half an hour. So without learning the basics of market profile, there I used to see the journals of, there were many good traders there who used to post their trades, and I said, okay, this is very good. They are doing very good every day in such a range. Those days Nifty was trading in 5,000 range, and making 20-30 points was like good enough. So I said, yeah, if these guys are making, I can also make it. And what you have to do is nothing. You have to just see if the value has developed higher or the value has developed lower, and if it's above the VH or below the VL. Only thing is that you have to see, and done. You have become a millionaire in a year. Unfortunately, that didn't happen. When it didn't happen, I started again finding something that, am I doing something wrong? Is there another method which can give millions? But finally, I thought that no, I have to settle down. I was liking this theory a lot, but was not understanding it. So better understand it. So then I read the CBOT market profile handbook, then read markets in profile, then read mind over markets. Now it was going everything was going above the head. So if somebody asks, I can't say that I'm not understanding. But in the back of my mind, I knew that I'm not understanding. Now, who will make me understand was the question. Because now this guy, Digvijay Singh Jadeja, doesn't know about market profile. And those who know about market profile would not teach me. So I kept on asking many people. And in those days, there were very few Indian traders who followed it. And out of those few traders, few were running advisories. So I thought that, okay, if they are running advisories, at least they will teach me. So I went to them that can you help me set up Investor RT, because Investor RT was better than AMI Broker for profiling stuff. And I thought that at least that much I can lose per month to learn. If I can lose like that time Investor RT was $70 per month, and I could take just one segment data from eSignal and start applying it in real time. If I can recover half of the cost of the software also would be good. So I said, let's do that gamble. So I requested 2-3 guys to help me in setting up Investor RT because it was tough. I subscribed and even I could not get the Nifty symbol. So the replies were like, all were reluctant to show you how to do it, because they thought that if I learn, what if they stop making millions and I start making millions? There is a mentality everywhere. Everyone thinks they have a secret, and if they share that secret will no longer work. Now this market is so vast that even if I give you my system, I give you this system to trade, I call you here that, okay, take my system. This is exactly what I used to trade and you can trade on it. Definitely the trades will be different. Till it is not automated, there is no way that two minds can be equal. So I got depressed with the replies, and a few told that this technique cannot be learned that easily. The data, you require the purest form of data. You require, the costs are very high and you will not be able to afford it. So there were like thousands of excuses. And today, one thing I'm proud of is that in all these years, at least I climbed that ladder where I wanted to reach, and I'm able to trade on my own and almost have reached a stage where now I don't want to learn further into the market profile theory, but I want to just find minor, like there are very tiny nuances within the day and at each moment as the auction develops. So now I am trying to make something out of that on my own rather than just relying on the theory. So at least I'm happy that I reach that stage, and I get more happier when I see that those guys who stopped me from learning are still advisors only. They have not reached even the trader stage. Now, after I got done with the market profile, so basically the market profile is all about time versus price. Volume profile is volume versus the price. So then I started with volume profile, and now Indian markets, when you see the webinars, or when you see read any books about volume profile, mostly they are by American or European traders, and their market is so liquid and very organized. Like it's a tough fight. Suppose in India there will be 40% people following technical analysis. There would be 90% people following technical analysis, but not applying it very effectively, and that's why losing. There also the retail loses, but the fight is tough, and the data is much organized than what we have in India. So you will get a nice volume distribution over prices. So in a price range, if it's going from 100 to 200, you will get a nice distribution happening at each price. But here, if you see like Nifty index, which is trading at 8,900, has a tick size of 0.05. So at each tick, if you see the volume, at times you won't even get the volume. So while learning volume profile, it was getting difficult. That you watch the videos, and you start trading similarly, because that is what you learn. And when you apply it, it's a failure. Like it's not working that precisely. So again, you get you have a bit of discontent towards that study. So there I thought that, okay, there should be something working, because these guys who have made it would not be fools. They would have seen something and made these theories. And finally found out a way that, okay, let's try to stretch that profile to a point where the data looks organized. Because if we can't construct something, let's do reverse engineering. And luckily saw that, okay, over a period of time, if you are plotting a volume profile, it works in a better way. So you find that edge which suits your nature. You have found a sweet point that is tradable, and there is no harm in using that point. It might not be exactly as per the theory, it might not be what is written in the books, but if it works for you, nobody can stop you from using that. Then now everything almost was done with profiling, but still that the profitability had not come, and the losses are still there and not recovered. So what to do? So then I started learning volume spread analysis. Like there was again now what happens is, after few months, you would see the Twitter will be full with some buzzword. Like 2 years back it was market profile, then a year back it was order flow, and currently it is delta divergence, and next can be, I'm trying to make this cumulative tick a buzzword. I might not succeed, but and next now there are 50 people here today till now. Out of these 50, if somebody decides, okay, let's make something a buzzword tomorrow, and 49 of the others retweet, it will become a buzzword. Doesn't take much time. Only thing is, you need to get few retweets, and then 10 people talking over it, and it will become the talk of the town. People searching it, the Google searches will increase, and that is the point where you want to sell something related to that keyword. Yes. So now see, all these studies were existent, and there is nothing new about it. Price action is fair enough if you can master that. If it suits your nature, then there is nothing that can stop you from making profits only from price action. It is just that you are finding something which you are comfortable with. It is not about that one theory is good or another is bad, or one theory is superlative. Obviously there will be advantages and disadvantages, own merits and demerits, but doesn't mean that nothing works. Everything might work effectively if used with that precision and used with that knowledge, which, and specifically if it suits your nature. Till your nature is not accepting it, it's not going to work. So finally, because for me it was not working, so I had no choice but to explore. And while exploring, I thought that okay, this volume spread analysis looks good. If I learn this, because what it said, all the forums when the thread started said that it is how you track the smart money moves. Volume leaves a trail of the intentions of the smart money. So I said, okay, yeah, this is the thing which I want. Now I want to do this, because if I can learn volume spread analysis, then I think nobody can stop me from making profits. So started learning volume spread analysis. Now when I went, like, from outside, again the same thing looks very good and very easy as well. The moment you start studying it, a bit difficult, then gets a bit more difficult, and by the time you are just like getting the hang of it and mastering it, you will start feeling that it's very difficult. And that is the point where most of the traders give up. Now it is as easy as price action, but it is, because it is not fitting your nature or maybe your grasping capacity. Exactly after toiling day and night for a few days or a few weeks, and after losing, obviously, if you apply, you are going to lose money. So, and if somebody makes money, then they don't need to actually learn, because if you are making money by applying it from the beginning itself, then I think we'll not even reach that point where we learn it completely. So now, after going deep inside, I thought that okay, this is very tough. And also, again, the same thing, will the instrument behave the same way like it is discussed in the books? I saw that it behaves sometimes, does not behave at some other time. So then what I did is, okay, when you start learning the basics of it, when you can understand the logic behind that theory, then you can modify it. But till you don't understand, you have to follow what is written in the book. So the essence of volume spread analysis is demand, supply, and the result of the efforts. Market is doing an effort to rise. Is it giving desired result versus that effort or not, is what the volume would tell you. So keeping that logic in mind, I started like narrowing down my perspective that okay, uh, a bag holding pattern, don't want, remove that, because that we can make out from the candlesticks. We don't want volume to ascertain that. Then, like, there are numerous patterns, because if somebody is pursuing VSA in its entirety, it is a complete system. So you have to like apply each and everything, like you learn about candlesticks, that there will be bearish engulfing and doji and hammer are not the only patterns. You will learn like homing pigeons and three white soldiers, three black soldiers, and evening and morning star, and bullish and bearish Marbozu. And so when you start learning about patterns, there are so many patterns in candlesticks. So similarly in VSA, there are so many patterns. Yes. So After narrowing it down, started realizing that okay, this is what works. This is it's the market is going up, the range is narrowing down, but the volume is picking up, and that means there is some distribution happening. The range is narrow, that means they don't want to take the market up like they were doing earlier in the when the trend started. So you start getting that hang that okay, this trend might be ending. So whatever was required, I started following that. So there is only like few things, which is upthrust, a stopping volume, no demand, no supply. So those basic four things, and combine that with, because see, there are different type of upthrust. Upthrust is one word, but the upthrust can come with a huge volume coming at the fag end of the rally at the highs, with a huge spread bar closing off the highs, and preferably near the lows. So that is the primary idea of upthrust. Now it can come in different ways. It can be the spread might narrow down completely and the volume might shoot up. That is also one type of upthrust. Then the spread might wider, the close might be lower, and the volume would drop drastically. That is also an upthrust. So then I realized that okay, once we are through the basics, let's now start going into some advanced techniques. That let's find how the market behaves when a different type of upthrust is there. Because earlier it was just learning the primary, then going into secondary, and then going into tertiary, and so on and so forth. Now currently I trade Nifty and Bank Nifty futures. Prefer to trade stocks in cash, because what happens is I get when you invest in stocks, you get to use the collateral. So you can use that collateral for Nifty and Bank Nifty futures. And suppose for X capital, if you are investing in stocks and the stock is going up 10%, you are obviously going to get that 10% on your capital. If your entire portfolio goes up 10%, you are going to get that 10%. And for the rest of, for bread and butter, Nifty and Bank Nifty is there. So you can take few points every day or every week. So I think that is it. What I wanted to share about me and how I started. So now we'll start with auction market theory. Yes, crude oil. Now what has happened is crude oil futures I have not traded like in 2017. I have traded just once, because what has happened is, due to this, the schedule is getting hectic and need to be there throughout, because crude is like you cannot go to the washroom also, because the US markets open, you go to the washroom, you come back, and the stop loss is gone. Now I'm a very aggressive trader. That might be one of the reasons, because I want to like keep the stop loss minimum and keep the targets also minimum. So auction market theory. In 1985, Chicago Board of Trade introduced market profile graphic as a part of the CBOT product to the public. So it was introduced as a part of the CBOT product, and it was accessible only by the clients of CBOT. J. Peter Selmayr developed market profile to evaluate the market value as the day develops, and hence it is an intraday charting technique. Now this is very important, that those time there were pits like the rings which we call them here. So the traders used to gather there and then shout out. So it's like a normal auction. You go to a auction and the auctioneer starts the auction and everyone starts bidding for it. So the markets function in the same way till they started electronic trading. So Peter had observed that there is a distinct behavior that happens every day. So there are few players shouting the market is trading at 100 and few players are shouting 102, 102, 102. Then somebody shouts okay 105, somebody shouts 110. And then what he observed is there are places where the shouts are from everyone and there are places where the shouts start decreasing. And that means that is a behavioral change. And based on this, he tried to run some statistical calculations, and then he observed that okay, if this can be devised into a theory, can be of advantage for all the traders. And that's why finally he decided to make it into a theory, devise rules for that, and named it market profile. Professor Thomas P. Drinker was the first person to introduce a market profile course in academia in 1987. And till date, that university runs a course as a part of the curriculum. I think even CMT doesn't have market profile as a part of the curriculum. Means not a compulsion. Later, Peter and Kevin Coy started the Market Logic School to teach profile trading. Now, that is where they wrote that book, and also Peter and Kevin developed a software. So earlier it was their software that people started using for market profile. After CBOT gave away the market profile to Cisco Futures, and then Peter and Kevin Coy started the Market Logic School. They started teaching about profile, and it started spreading its wings and became popular amongst prop shops and many professional traders in the US. James Dalton developed it further and made various changes as electronic trading started to take over the pit trading. So what happened is when the results started changing, now see, this is the change in the behavior which kills a trader. Now, though Peter had devised the theory, the moment he saw that it is not working as per his expectations, he started thinking that the theory might not be working in the current market conditions. Instead of that, he could have made changes, he could have found the reasons why it is not working as it used to work before, and he would get that advantage and he would get that credit of making changes, and he could have come up with a better version, because the maker of the theory knows the in and out of it, and if he is making some changes, obviously they are worth it and everyone would follow them. But instead what he did is he moved on because he wanted to develop other statistical products. So he joined CBOT. Currently he gives, at times he does seminars for CME, and there he developed again a new technique based on this profile strategies, but now it is more of a statistical analysis, and he follows it for option trades. Now many of you would be aware that we call it auction market theory, so there should be an auction to create that theory, and auction is basically nothing but the price moving up and down. So that's why we call it a two-way auction process. Markets are existent to facilitate trade. Trade facilitation takes place through a two-way auction process. If the markets were not going up and down, the trades won't happen, because as a buyer you are waiting for preferable prices which is always lower, and as a seller you are waiting for preferable prices which are always higher. So you have bought at 100, you want to sell it at 101, or you are a short seller, you have sold at 100, you want to buy it back at 99. So this behavior where you participants are seeking higher or lower prices, that's why to facilitate a trade of a buyer and seller, the market needs to go up and down, and that's how the trade facilitation occurs in a two-way auction process. Now 30 minutes of trading activity of one day will be equal to the 30-minute trading activity of another day. Like suppose NSE opens at 9:15 to 9:45. The next day also it's going to open at the same time, and you are calculating a fixed time, so it will go on till that time. So the time is not going to change. The day has changed, but the time will still stay, because you are defining those 30 minutes and they are going to stay the same on the next day as well. What changes in those 30 minutes is price. Purpose of market profile is to organize the real-time evolving database, to collect the market generated information of the two-way auction process and present it in a graphic form. So the prices are going higher and lower in a 30-minute bracket. Then a next 30-minute bracket starts. Again, the prices will be going higher and lower. Now, when you see the candlesticks, you will be seeing the OHLC. That is also one way of charting. So here what we need to do is we are organizing that two-way auction process, then defining a time frame, considering a 30-minute bracket, and then plotting it as a graphic. Now the first question arises is why to use a graphic? Because when Peter devised the theory, it was based on a statistical distribution curve. Then why to use a graphic? Research shows that human brain can interpret images that eye sees in just 13 milliseconds. 90% of the information transmitted to the human brain is visual. Now see, our brain processes visual 60,000 times faster than text. So now, due to this phenomena, now this earlier the time used to be in a research, they found out that it takes 100 milliseconds for the human mind. Then in further research, the doctors and the scientists could find out that no, it takes just 13 milliseconds. So here, at least when we are learning, we get one advantage over others, that we are looking at something that our mind can process very fast, and that's why we use that market profile graphic. Now, what is the market profile logic? The logic of the market profile graphic is to plot the time as a constant and price as a variable. Now, I think most of you are here because everyone is interested in market profile and auction market theory, or has already learned and is just trying to explore and just share their knowledge with me, or I am sharing my knowledge with them. So this basic does not need to be actually conveyed here. But why I am doing this is, this mindset needs to develop. We need to take the basic, because if the basic is fine, we can construct the building as high as we want, but if the basic is not fine, then there is no point just constructing floors on that building, because it might collapse anytime. Now, price advertises opportunity. Time regulates the advertised opportunities. Volume measures the success or failure of those advertised opportunities. Now, as a sentence, very short and sweet: price advertise opportunity. Okay, what's so great about that? Time regulates the advertised opportunities. Everyone knows market opens at 9:15, it shuts at 3:30. So again, what's so great about this thing as well? Volume measures the success or failure of those advertised opportunities. Again, the same thing. This is getting ridiculous that we already learned that market breaks out with volume, we need to buy, breaks down with volume, we need to sell. But no, this fundamental logic needs to be understood, because as a sentence it is just three sentences, but as a logic and a basic part, it's much wider than we think. If we start appreciating the market, if we start appreciating this small sentence, this has a very vast meaning. At every moment, the market is trying to tell us something. And I had this bad habit that I want to react to the market instantly. Like the market going up, I want to buy. Going down, I want to sell. So I'm like very aggressive. I want to just get in. Slowly, I understood that it is not possible to always just jump in and get the profits. We need to understand what is happening. The market will give enough time for entry and exit. Things are not going to change within seconds. Though our mind is used to reading the graphic information in 13 milliseconds, but we have much more than that to trade. So better to watch what is happening. Let the price advertise the opportunities. So price is advertising opportunity by going up and down. So let it go up. Let it find some acceptance there. Let it see. Let us first wait and see what the price does there when it goes 2 or 3 points higher. Then we should set all our parameters of trade and then enter the trade. Now, while the price is going up and down, the time is running. The clock has not stopped. So what is happening is, at times the price might travel 10 points in 30 minutes within a range of 100 to 110. The second 30 minutes start and the price is still there. Or the second 30 minutes the price goes to 115 and comes back to 108. That might also happen. So first, if we start understanding that, okay, price is an advertising mechanism, we should not get attracted to it. What generally happens is the price goes up and our blood pressure also goes up. Oh, we have missed that trade. A friend told me in the morning that by Reliance, it's going to open gap up. After opening gap up also, it will rally. Shit, I have missed that trade. The friend told you is fine. Reliance went up is fine. It's not a compulsion that you have to be in that trade. Now then, the time is another factor which creates the fear. It's already 3 hours you are sitting in front of the terminal, you have not got a trade. Oh, the time is going. Now I have to get a trade soon, otherwise I might miss the opportunity. No. This is actually where the opportunity is building up for your trade. So consider in that way, that will create a lot of patience in you. And volume cannot be considered by just that one part, that market breaks out with volume is a buy and breaks down with volume is a sell. If it was that easy, we can just program it in that way. But that is now not how the markets behave. Now combined together, the market profile graphic shows us the structure of the price movement and the emotions of various participants. By understanding the structure, we can analyze who is controlling the auction. Now, the next is the building blocks of market profile. I'm sure everyone must be knowing about this. Bracket. So each 30-minute period of the day is known as one bracket. There is a confusion always I keep on seeing. Few people would say that it should trade 2 TPOs above. TPO and bracket are different. 30-minute period is a bracket and TPO is time price opportunity. Each letter formed when the price travels through 1 unit price of a bracket is known as a TPO. And the graphic consists of value area, again divided into 3 parts: value area high, point of control or the fairest price, which we call it a POC, and value area low, which we call it the VAL. Now, what is value area? The one standard deviation of a distribution curve which forms with the price movement during the day is known as the value area. In other words, the value area is the horizontal area within a day on the market profile graphic where the 68.2% activity took place. So this is a statistical standard distribution, and if you just turn it clockwise, this will look like a market profile graphic. So now let's go to the graphic and just see the basics of it. This O is the open. So the A period has opened and gone up and down. The B period stays within the A period. So now my database is set to okay. You can put your questions. We'll take because see, these questions I want to complete this part first, and then we'll go into Q&A for this entire auction market theory part. Otherwise, what will happen is everybody won't get a clue what I am answering actually. So this A period as per my database would be of 15 minutes because I have taken 9 o'clock database because I want the last bracket to be 30 minutes because last 30-minute spike is more important to me. Now same thing, if you are making a 30-minute chart would look like this. This is your A period. So 10th February we are watching, and this is the 10th February first candle. The second candle looks like this. Third candle looks like this. Now what we want to see is value. So this is the developing value, value area high, point of control. Here you can see the point of control is migrating higher, again migrating lower and staying here. So now see what has happened. The price spiked down in this G period. So this A represents one price. Each letter will be printed at 1 point move because I have set at 1 point. So it will move, opens here. If it goes 1 point higher, it will print another A. If it goes 1 point lower, it will print again another A. So at every 1 point, this will print one letter, and that is known as a TPO. So you have multiple TPOs in A period, B period, C period. So all these are 30-minute high-low bars, you can call them. And each each letter is printed at every 1 point interval. You can set that interval to your your specifics, the way you prefer, not a norm, but generally if you can get the lowest TPO size you can accommodate is better for calculations. Now when I combine these brackets together forms, this is a balanced day, and that's why you can see a nice bell shaped curve. So what we were looking in that slide is what we can see here. This doesn't happen always, but this day is an example of a perfect bell curve and a perfect balance. Now here what has changed from that split? If we are looking at candles, it was different, and now when you see here the splitted looks different. When you are combining this, generally we call it a market profile daily chart, but actually it's a market profile daily composite. The daily would be splitted, the composite is combined. Composite basically means combining something together. So this is a daily market profile composite, and on the composite what happens is, on the candles, when this candle came down, it is not going into here, but here price is the variable, time is constant, so the price has changed, so it will come here because we are taking a daily time frame. So the time has not changed, the bracket within that day has changed, but the day has still not changed, so it needs to be plotted below the A. So when this low was broken, the A period low is broken, it goes and plots below the A period. So that is the major difference, that when you combine it, you are plotting the prices over time, where the prices are going up and down and time is constant. Now this is a very, very important thing, because this needs to be understood to the core. Otherwise what will happen is, no matter if you master everything else, this logic won't be clear and you will be looking for stuff which doesn't exist. And that is the reason, like, see, everyone jumps in to learn, or everyone jumps in to follow a particular theory, and they take a shortcut. Okay, somebody says that this thing is happening and we call it like this. Okay, let's jump in and follow that. Next day, as another person says, okay, this is happening, let's follow that. Now the same thing you don't do in your language. As a child, when you are born, you don't even know your mother tongue. For a year or two, you are just like trying to even speak. You can't even spell ABC. You can't even talk that. But as you grow up, you start learning your mother tongue, and there is no debate. You start learning exactly how the entire family speaks, and you automatically start learning. There is no fundamental logic of it. There is no nothing to be taught in specific. It's a process and automatically happens, because there the thing is, the money is not involved, the greed and fear is not involved. So you start learning it as an automatic process. But in markets, you can't do the same thing. You want a shortcut, you want to jump in and instantly start making money. There is no motive. You are just learning for the sake of it, because it's a process, and you need to communicate with everyone. Slowly everyone starts talking to you, calling you, and you realize that, okay, to reply back you have to learn that language. So there you slowly and silently, calmly follow the process. But in markets, everyone wants to get a shortcut, like skip all the basics of it first. Because if we learn the basics, we are not going to make money. But the thing is, if we learn the basics, then we can at least devise something of our own. Then we can think over it and make it work even in a much better way than the makers of the theory would have thought. So now the this no time is a constant means this day has not changed. The bracket changes. The day has not changed, and that's why we are calling it a daily composite. If this was a 30-minute composite, then the time has changed. But a daily composite, the time has not changed. The brackets are changing within a day. So your time frame is daily. Within the daily, there are brackets. And at each passing time, so each bracket is passing, that time it is, see, if the price was here only, the B period is not going down. The C period is also not going below A period. The F period, E period is not going below or above. Only this G period went below A period, and that's why it is plotted below. See, rest of them are still stacked here only. And that is why that value is developing. If like G period, all the prices went here and there, the value won't develop at all. It is the time versus price where the time is constant and price is a variable. That is the reason that when the variable starts behaving like a constant, so the range decreases and starts passing time in a narrow range, is where the value would be created. And that's why this is very, very, very important, that the creation of value, how the value develops, is very, very important. It's not about just the value area or the VAL and VAH. It is about how it develops, where it develops. And for that, actually, you came up with this. Actually, I already had a question that I would ask. I thought that once I know that once I am through this, I wanted to do a poll that to find out whether everyone has got the basic logic of it or not. So here is the poll. If everyone can answer it like quickly so that we don't waste time on this. Okay, and ended the voting. I think two people would not have voted because I wanted to end it in as quick as possible. And can everyone see the results? 85% people have got it right. So this is a very good sign that till this understanding is there, you can now my confidence is actually growing that if this is what everyone knows, then they can like develop their understanding about market profile in a much better way. That is what actually I feel the other way, that I am not a good teacher, because that is not my profession. And uh, I keep on discussing with my friends that I intend to like share the knowledge and teach, but when I see others, like there are very good, like you listen to Jim Dalton talking, and you will feel like that your mind will start receiving that information in a much better way, because he knows how to teach in a much better way. Or if you listen to FT71, the way they talk, it has a certain very good quality about imparting that education. Because see, I might be knowing everything, but a teacher needs to make the students understand in the way they want it. There is a limit to that it can't be exactly the way they want it, but still it needs to be in a manner that they can internalize that information which is coming. And I was lucky enough in the school that I had never even bought like after I think 6th or 7th standard, what used to happen is I was falling short on my pocket money. So what I used to do, I never used to buy the books. Only from the information I receive in the class, I used to write the exams. And while writing the exams, I used to make sure that I keep on doing reverse engineering there. So maybe that has become my nature. What I used to do is write 65, 68 marks and start checking where can the teacher cut the marks. If it is above 60, then fine. At least at home, nobody would be angry. I've got first class. So that became slowly became a habit, until I reached the board exams where they said that first class won't work. You will require distinction. Otherwise, you will not get admission in engineering. And maybe that was a drawback as well, that in board also I did the same, that I wrote for 68 marks, and so few papers I wrote for 68, few for 72, and finally got 61, which was just at the edge and ended up in a least preferred college. So now various market profile nuances, the opening types and day types, balances and imbalances, shape, structure of the profile, weak, poor and mechanical references, anomalies, key reference areas which we call KRA, initiative and responsive activity, inventory buildup, shifts and adjustments, initial balance and range extension, auction failures, acceptance and rejection, prominent and very prominent point of control, excess and tails, exhaustion versus continuation, pullback low and rally high. So these are various terms that we use to define what is happening during the day when the auction develops. Then there is type of traders and the time perspective. So one is day time frame trader, which we call them DTF, and this is, you must have all must have heard this every time. Day time frame trader basically means a trader willing to trade during the day getting in and out of the trade multiple times, but at the end of the day, they exit all positions. Day time frame traders facilitate trade and provide liquidity to the market, as they have a significant amount of money to trade, but their perception of value is extreme short term. They do not move the markets, but generate volumes to an extent that we get an illusion that they are controlling the entire auction process. They trade huge quantities to make money in chunks, and when countered by other time frame traders, they tend to exit fast with minor or no profits, or even by taking minor losses. So this is basically a very short-sighted trader. Like they want to get in, get out, get in, get out. The can be working for a fund also. So he has been given 100 CR to trade, but they say that we don't want overnight risk. So this trader trading on behalf of that fund constantly has that in his mind, that come what may, he has to enter the trade. If he can take 2-3 points, then fine, because they are trading on a prop desk. So the brokerages are nil and only the transaction charges. So they want to get in, get out. And when they are doing this, obviously they are creating liquidity, because suppose if we want to buy and they want to sell, so they will have such huge quantities that our trades will just trigger at that point. Then the other time frame trader. Now this word has a much broader meaning than just like we always talk about OTF, the other time frame trader. Other time frame trader basically means a trader willing to trade during the day and can even carry the positions overnight based on the perception of value. Other time frame traders are looking for opportunities to counter the day time frame traders and generate profits, and have the ability to create further positions to move the markets beyond the perception of the day time frame traders. They are most of the time controlling the auction process during the day, when the price tends to go above or below their perception of value. Other time frame traders can consist of shorter time frame, intermediate time frame, and longer time frame traders. Shorter time frame traders mostly behave almost similar to day time frame traders and take their opportunity during the day to stop a directional move or start a directional move, to take profits and exit or carry positions for 2 to 3 days. Intermediate time frame traders have a broader perspective, and their perception of value is completely different from the day and short time frame traders. They respond to unfair prices with their perception when other traders are exhausting their capacity to move the auction. Long-term traders are the most powerful of the other time frame. They respond to unfair prices with their perception of where price can find value in next few weeks to few months, when other traders are exhausting their capacity to move the auction. Long-term traders have the capacity to take decisions individually, and their reaction can create a huge directional move that can last for few weeks to few months. Now, this is like the other time frame we are talking about, which is currently working in Nifty. If you see the way it is trending, so everywhere the short-term traders would start thinking this is the top, and that has been the behavior since many days. Every time the market is going up, the short-term traders would feel that okay, no, the top is here. But what happens is the market still keeps on moving higher, higher and higher. So if we go to a daily chart, we can see that the market is going higher, 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 again going sideways, again going higher and higher. So this behavior is of other time frame. Here, if you can see, the market started going lower. This is the place where the other time frame might think, because see, if the other time frame is moving this auction up, this is where they would think that why are these traders trying to sell this market, and they would come to react because they can't afford to stop this auction. They want to make it go even higher. So when they see unfair prices, now unfair is not just defined by the shape of the profile or because it is their perspective and we cannot rule them. We cannot teach them that okay, this is the POC, how can you buy it here, this is where the auction should rotate. That would not happen every time. It might happen but not happen every time. It's not a norm. So a person having few thousand CR and having a long term perspective would just call up the broker, okay, do one thing, I think the market is going too low, this is not what I can perceive. And what he is thinking is, he is thinking about the future. He is constantly thinking on what can happen next. He has the ability to see the future. He has the ability to understand the geopolitical situations. He has the ability to understand how the corporates perform during a certain period. So their perspective is very different to what the shorter term time frame traders have. And for him, this is an unfair price. And he reacts, and they have the ability to buy even higher. So when it crosses this high, if there are no buyers, the price will come back down. But they have the ability to hold up the prices and keep on buying. And that is why this behavior happens. So these big moves are created by the long term other time frame traders. Now balance and imbalance. Balance simply means a trading range. Imbalance, as the name suggests, is the opposite of balance. A trending auction on one side puts the market in imbalance till the market participants can find value and put it back into balance. The market auctions up to seek sellers and auctions down to seek buyers. As this process keeps on happening across all time frames, the market stays in balance and goes into imbalance as a continuous process. Now, we were just talking about this, that now the reason I am taking this candlestick chart to explain is on a daily chart, we do not need a market profile graphic. We need to follow a top down approach where first we go into a monthly chart, then we come down to a weekly chart, and then finally we go into a daily chart. The previous snapshot, just a second. Yes, here it is. So whatever, like any logic, any study of profile is applicable on all time frames, and the auction does the behavior which it does in 1 minute would be happening in 2 minutes, 3 minutes, 5 minutes, 15 minutes, 30 minutes, a daily, weekly, monthly, everywhere that is happening. Now this is a daily chart. So here you see the market Now what is balance? A trading range. So till this day was developing, you had a trading range that the next day, suppose if this day has this range and the next day the open is here and trying to travel here, till then you have a range. So from a range, it is breaking out of the range. Now when it's breaking out, if you see the weekly candle, it would be still in the weekly range. So you have drilled down from the monthly, then came to weekly, then came to daily. So on daily, the trend was down on weekly as well. On daily, it is trying to engulf this bar completely and go higher. So on weekly, it is entering and still into that range. It has not crossed that range. So on that time frame, it is a balance. On this time frame, it has broken out of the balance. Again, what happens is you get a trading range just above this close, and the second day also is almost the same. So you have a 2-day balance. Now, many people prefer to draw composite profiles of these 2 days and then see the structure within. But this information is recent. So better to see it as a daily composite, because if the theory was devised as a intraday technique and as a daily composite profile, then better to watch it that way, because balances can be seen from outside. If we have a landscape view, Jim always keeps on telling that people tend to go much deeper, which is not required. People tend to get into the charts. They will go into each and every tick and see, okay, a buyer is coming, a seller is coming, market is going up, market is going down. He said the profile is not about that. The profile is about knowing the perspective and perception of value of multi-time frame traders. So here, after that balance, the market again breaks out. Now here what is happening is, though the range is almost the same and a bit higher than the previous day, but what is happening, let's zoom in a bit. It is still trying to go and make a higher high. And then what happens is, here it is not able to make a higher high. So altogether this can become a balance, but the underlying context is that the market is one time framing. Now one time framing simply means that the lows are higher than the previous low in this case. The high need not be higher. Any one of that should be higher or lower than the previous bar. So like this is one time framing down. The low is lower, the low is lower. Here the high is also lower, but even if this high was higher and the low was lower, it is still one time framing down. Here it is one time framing up. Now this is a very important nuance again, because this is the time where we get frustrated. Oh, the market is not even going above previous day's high and staying there. What is there? The trend is exhausting. It's all going to get over. We are going to see 7,500 soon. Yes, we will see 7,500 soon, but let the market tell us that. If we are following a particular way of analysis, there is no point in anticipating against what we learn. So a simple fact is, let it break one low at least and stop this one time framing, then we'll think of that. Here it has done that. But what has happened? You have a balance lower. There was a balance being created higher, and the market is still within that balance. So after an imbalanced move, the market is trying to accept these prices and create value there. Now this is where that fundamental logic, the basic and the building blocks come into play. If we were too much into just the VAL and VAH, our perception would change instantly. But if we are looking from far, if we stay back on our chair and look at this as a whole picture, like everyone would have heard about 70 film and 35 film. Nowadays what we see now, the films have stopped, but nowadays the screens we had are 35 75 is not existent. But the pleasure of watching the movie on 70 is much better, because that is crystal clear. And same way the markets will be crystal clear if we look it from far back. If we are looking like this, we don't have any information, but the more we zoom out, we have more and more information. So here, if we have that sort of vision, we are seeing that okay, the market was going higher. Now it is trying to accept those higher prices for either reversing or continuing the move. Now we don't know what can happen next. To know what can happen next, or at least what can happen in immediate future, that is where we go into the daily market profile chart to see how is the structure looking. But till then, candlesticks are good enough. So anywhere on the daily or weekly chart you see a trading range, you just mark it as a balance. So what I generally do is, this is a range, so mark the center where all the bodies have traded as a fairest price. We don't even need to check whether the prices have really traded there or not, because if this range was established, it is a market generated information and this could be the fairest price. Then you see the market trending higher, again a balance developing. So again you can see inside bars happening and the market not willing to go on one time framing. So you have a range again. So what you do is again the same phenomena. You mark that trading range and again you have a point of control there. The prices have traded across this price. Now the market goes down. Is it going below this low from where it broke out? No. Is it going into this balance? No. Now, if it is not going, what does it want to do? We don't know. We are also anticipating. So when it reverses and see, this was the open, it goes above the open, and that means the same behavior that the market is not interested. The participants are not interested in lower prices than this, because they were perceiving the value to be somewhere here. So first priority of those participants would be pull the market to this fair price, because this they have established as a fair price already. They will pull it back there and there they would decide where they want to take it. Now it can very well fail and start pushing down, but this time it starts pushing higher. When it starts pushing higher, again it has gone into imbalance. Again it might start one time framing, so we await the information. Now what happens is it really starts one time framing up. Now there is a gap here. So again important information. You get a 2-day balance, breaks down from the balance. Now we need to again wait. A day time frame trader can trade within this range through the day. So during the day he can trade. But if we want to carry positions, we need to wait for further information, because it has not even come and broken this low. So at least it needs to break this low to do something. What happens is it comes here, again breaks that low as well, and then the same behavior which happened here, but this time with a greater force. Last time it could not even go above the high. This time it goes above the high and goes above even this swing high. Once it goes above this swing high, what happens is your 2-day balance is there. So the fairest price is somewhere here. So this becomes your reversal level. What the market does is fails to stay above this, but stays at the edge. So again, in this 2 days, you have got this as a fair value. The market goes up higher, again starts developing a balance. Now you again draw this range, you find the price where all the bodies are there. So almost this price has traveled, all the bodies are there through this line. So this can be the fairest price. What happens is it comes and tests this fair price and again opens above that, and it's open above the range and fails and comes down. So this is like how you watch it from outside. Now we can go inside and check what has happened. So this was the day where it engulfed everything and crossed above the high. So what has happened inside? You had a prominent POC. Prominent POC is basically if there are lot of brackets at us, so a price where mostly all the brackets have traded. So if you see, A period has traded this price, B period has traded this price, C period has traded this price, D period, most of the brackets have traded through this price, and that's why this becomes a prominent point of control. So you get a prominent point of control, the market is not able to stay below that. Now these references are important. No, HVN is not POC. POC is where the auction has taken time, not volume. Volume is irrelevant. We are not talking about volume at all. That's a part of volume profile. We are talking about TPO based profile. So time needs to be taken. Volume is irrelevant. The volume is created here, but the time is taken here. So for us, this time is the matter of concern because it's a fight of time versus price. No, cannot be. And the proof is right here. Because the market might spend 5 days in a range with all least volume bars. There is some event lined up, and the market might trade within a range and create a huge value with the least volume in the century as well. And that is where like you see Reliance has created, or Bharti Airtel, or even Bhel in the previous results. It created like huge volumes, but it was not value. There was no value in that day. It did not take time. It did not consume time in a particular range. What it did is it just went higher, higher and higher without doing anything. And see, this is also important that many people get confused between market profile and volume profile. Market profile is different, volume profile is different. So what has happened here? It tries to, there is now, this is the information which we are looking at. So we had nuances listed where we had anomalies. Any price sticking out like this is an anomaly. So if the market was not emotional, if the players were accepting these prices fairly, it would not have left this. So these are anomalies. This is a very elongated day. So the first information which we have from this is this might get repaired. Now might get repaired and will get repaired are two different things, completely different. Like generally what will happen is you see such anomalies and next day you will see tweets, auction was emotional, it will get repaired. Yes, there are rules that it might get repaired, but it is still a probability and not a compulsion. The market doesn't behave like we want, because if it was like that it will get repaired, you don't have to do anything. You see such a behavior, sell. It will get repaired, you directly keep an order here to buy. That price might not come in next 2 years as well. It is the current information that we are looking at. So the current information after this was a gap. Gap means the market wants to advertise prices further higher because it is getting buyers, and market will keep going up till the last buyer is buying. Now here what happens is it creates a P-shaped profile. P-shaped profile generally means a short covering profile and is weak kind of profile. Though the prices are going higher, but they are going due to short covering and not fresh longs. And that is a perception again. We don't really know what is happening because this is not the open interest, or this is not the real position of those guys. We are not seeing the exact contracts, but we are trying to get a perception of what the different time frame traders might be doing. And if they are doing this kind of behavior where they give a huge range in one bracket and then most part of the day start trading in the higher part of the range, that means it will make a shape like P and it's a short covering. The second day becomes a long liquidation. Now it is exactly opposite of short covering. So if any fresh longs would have come here, when they see prices below the close of previous day, you might have seen people like saying it is trading below the high of yesterday, it is not that good. It is trading below the close of yesterday. No, this market is not that strong. So there are people who would have this perception, and as soon as they saw that the market has opened lower, it has come just to the close and not able to trade there, they would start exiting. And that is the reason that the auction is like trading in the range here. Now, for a person who doesn't have this and directly comes at the end of the day, would have that in his mind, that this is a B-shaped profile and is long liquidation. But a person who is watching this has a different perception, because here the context again comes into perspective, because the context is that the previous day we had a short covering and the base of that short covering is also important. So what has basically happened is the A period tried to go into the gap below the short covering but failed, and B period is not able to go below, and that means they are still accepted in these prices. Though there are few fresh longs which would have come in, they are exiting, but still the other time frame is still interested in these higher prices. Now next day what happens is market opens in the range of the previous day, pushes down and goes into this range. When it goes into this range, this is the point where you start thinking that if it is not able to go above the open or go into this, or at least the 50% of the gap. Now gap as per AMT is considered from the highs to the lows of the gap. So this is the gap. You generally like mark 50% is important. So suppose this is the entire gap, and you mark 50%. This is the place where it might want to actually create value. So it might want to trade here so that the gap is filled nicely. And that is the internal information. But what happens here is it's not able to trade there. It is trading even below this 50%. So when you see pullbacks coming here, you start thinking, what does this auction want to do? It might want to, now you have that reference that it might want to repair this anomaly. Till it was in a above this gap, you don't even need to think about this. Now what it did is it repaired the anomaly. Close was just off that. Now let's go further ahead. Now next day what happens is it opens above the close but is not able to stay above this fair price. And that means it is not interested in this gap. So earlier it was interested only in higher prices. Now what has happened is it is not interested in even this gap prices as well. See, it is not able to push into that. But now what does that mean? That means the other time frame was interested in higher prices. The weekly is trending up. And that means the short term traders who are fearful are thinking this trend might reverse and they are trying to sell each breaks. When they are trying to sell each breaks, their duty is to create value even lower. So because this is a accepted value, their duty is to create value. The moment they can't create value further, the moment they can't create value further down, what will happen is you will see the opposite force coming in, because the other time frame is still long. Other time frame is interested in higher prices. So what would happen is all of a sudden at a random price, some opposite force might kick in. The moment that kicks in, you are sure that okay, now there is an opposite force working and you don't want to fight with that force. No, you mean zoom in like this? Okay, I generally prefer zoomed out because uh, obviously yes, while it is happening, you need to see like where it is exactly going, but this gives you a perspective, a vision of what the market, because see when you see it like this, you know okay, there is balance here, there is anomaly here, there is this prominent POC here, there is this high here. So just to visualize that. And now what happens, E period breaks out. Now this is intraday gap. See, the value was being created here. Two brackets have traded, A and E are here, and all of a sudden breaks. F period is not able to come to this, and that means it has left a single print. Now on a bar chart or a candlestick chart, what does this mean? You would see that no, I would take a different chart because we want to see 30 minutes. What day is this? 1 2. So here what you want to see is the highs of that day, all the 30-minute highs, and any low after this breakout should have a distance. So this high, you mark a line here. So on any, even on trading view or any software, you just need to draw a line at the high of that bar and then the low of this bar. So this much area has single prints. None of the 30-minute brackets apart from this has traded in this range for that day. So very simple. Once you understand the logic, you can this is your profile. This is your balance. This is your fairest price of this balance. This is a intraday breakout. So what you were looking at the daily chart, now on the 30-minute you can make out, okay, this is one time framing up from now. So makes a higher high, the low is higher, the low is higher, the low is higher, the low is higher, the low is higher. So from here you know that you have an important reference here, you have a single print, you have one time framing up. The market might want to seek value again. If it was seeking value here, once it goes into imbalance for such a long time, it wants to again get into balance. And when it's getting into balance is not a reversal. So what happened later is it went into balance. The moment it establishes balance, again it wants to go higher. Now on this on the daily would just look like making a bit higher high and then falling back. But here you can see that, okay, it's trying to push up again, one time framing up. So this is what you can do intraday, that when you see a structure in the background is good, creating a balance, trying to come into the fairest price, not accepting there, would break out at some point of time. Now it's not necessary it will break out right away, but it will break out at some point. Now it is 12:07 already, and I think we might like we can finish this. I still have like few slides left in this, and then we'll break, and we'll do the Q&A after the break so that everyone can have lunch or take rest, whatever, and then we can do the Q&A. But I will complete my part before the break so that there is continuity, and then we can have the question answer again separately. Now another nuance is excess. Excess marks the end of one auction and beginning of another auction. Excess occurs on all time frames. It can be a day time frame excess, short term excess, intermediate term excess, or a long term excess. It is generally marked by the auction traveling high or low enough above a reference and falling or rising back and leaving a tail. Though getting a tail is not a compulsion. At times, the auction might get exhausted with a poor or weak high or low and later leave a gap or single print to confirm the excess. Now, what does this all mean? Now this is an excess. The market is traveling up, goes above the high, fails and creates value here. So when it's creating value here, what you make out is this can be a short term excess. Why can be a short term excess? Because you have a nice value lower, and a test of that value would still keep the auction in an uptrend. So when this happens, your first assumption is that this can be a short term excess, because what has happened is earlier the market was continuously, see, it goes above the high and starts building value, goes above the high, spikes up and wants to build value. Now here it has gone above the high but failed. But another important thing that you have here is exactly above the high you have a single print. And we were discussing just now that when you have this, that means this becomes a very important reference and a new auction has started which wants to even break higher. So till it's above that, you can just mark this as a short term excess, but there is no sign that even this might turn out to be a short term excess. Now where does it give sign? In this J period, it gives a sign. Oh, my this has changed. Just let me. There's a problem with the session. Okay, doesn't matter. We'll take another instrument, the current contract. Okay, that has also changed. Cool. So now this is okay, and let's get back the same thing. Yeah, now you can tell me what the two letters, what do you mean by two letters? KL just above breakout. Okay, yes. So if you mean to say that, yeah, this much part, this part you will consider as very important, because this is a gap which is unfilled. Because if the market would have closed here, you would have directly got a gap. Assuming that, so this, either you can call it a single print, you can call this an extension handle. So on the candlestick chart, what you need to see is any lows of other 30 minutes should not match with this. Till then, this stays. This single print would stay. So you take the, let me zoom in. You take the J period high and L period low has not come to the J period high, and that means the K period stays as a single print. So if you split this, see your candlestick would look like this. So this is your candlestick bar, and this is the next bar which is not coming into this. So this is a single print. Now here, see, this is not a single print because that day the prices have traded here already. Otherwise, this is the same behavior. You are getting this. The J period high has crossed the I period high, and the K period has not come till the I period high. So here also you have the intraday single print, but on the daily composite, this will be considered as a single print. So and this is also one of the important nuance intraday, that somebody trading intraday has a nice opportunity here. That one thing is, it was previous day's prominent point of control. Second thing is, you are getting single print there, and see there is a sort of a congestion here, which is a candlestick rule. There is no you can call it a ledge in market profile terminology, but it's same as getting two equal highs on 30 minutes and it breaks away from there is a nice sign that this auction wants to break higher. And the moment this breaks above this, you still know that it is going to go higher, and that happens. Now next day when this is happening, till this happened, we thought that it is still accepting the spike. This is what gave a sign. Now you have a reverse single print and the auction has closed this single print. So you have a new reference, and now you would think the auction wants to reverse, and this has already become a short term excess. So your excess is confirmed here. Now you get a gap, intermediate term excess confirmed, because a gap is a form of, at times what might happen is, you would get like all these highs would not be going above and you won't be getting excess, you will get similar highs, but this gap will confirm that the auction wants to reverse and the auction on the upside has ended. Now what it does is directly pushes through this, and now we keep on going back into history and keep on getting our levels. That where will it go? So step by step we should like go into older levels, that there will be prominent POCs, there will be some balance zones, there will be any anomalies. So that time those come into play. Till then we didn't need to bother about that. So now when it's traveling down, you have a prominent POC, then you have anomaly here, that all comes into play, and then you have again a prominent POC here. So what it does is, it comes lower, repairs this anomaly, closes just above the lows of the day. Now when the close is above the low, it is still weak because it is way away from the open and way away from the value. Now next day what happens? Opens lower, but just like at the edge of the range, tries to push higher, is not able to push into this balance. So value area is basically a balance. When you look at the bars, what you will see is a range, and that is a balance. So only this much is a balance, though the software has plotted value entirely, but your balance area is this much. This all is just price advertising opportunity, doesn't have value. So when it is not able to push through that, again what you are looking, any push through this would get it higher, and again what it does is gives you a single print. So now again you have a new reference. Till this is not taken out, you are still long. Next day continues higher. Again next day what happens, it's not able to push above. You get a weak reference. Now this is a weak reference that the highs are matching, and that means it's a poor high. We should have got a tail. When there is no tail, that means it's a poor high. Also, it's just one tick below the previous day high, and that means it's a weak high as well. But that's a reference. You carry forward this reference, you mark it on the chart, but you keep a watch on what is happening currently. The moment, now let's split this. See what happened? That J period was able to break the previous bar, and that means the auction might be ending, and you have a ledge here. So you have a nice congestion zone support. The moment it pushes into this, you have a poor low as well. So your target is almost getting into this. Then you have a prominent POC. That means the prominent POC, again a reference that these act like a magnet, and the auction might want to travel down there. So when this was happening, we do not need to preempt that, okay, no, I am short here. This is poor low. My target is this. This is prominent POC. Below this, my target is this. Not that way. Then you get into 5-minute bars or 3-minute bars or whatever you are comfortable with, and then start watching what is happening there. Because otherwise what will happen is we'll be like doing too much of analysis and ending up with nothing. So this marks that though it has reversed from here, come back here, close this, and that means this which was confirmed as an extension handle is no more existent. But see how cleverly they are able to close higher. They still are not ready to accept this balance, and that means the long-term players who were driving the auction higher from below are still in control, and this entire range is driven by short-term and intermediate term traders. The next day you get a open, pushes through this. Instantly we need to understand that this is going to break higher. So what it does, first it breaks higher above this and repairs this, creates a short covering move, and creates the highest balance in this range. Again a positive sign. Again next day a higher balance. Now when the market is getting into balance, we need to like closely watch what it is doing post creating that balance. Now once this balance is formed, if it wants to break lower or higher, what it will do is generally it will open here, try to push higher and start building value higher. Now here what it happened, it opened lower, there is a gap, the close was right here, and generally keep on observing this. When the market is in balance, the close is at the point of control of that day, the developing point of control. Generally you will get a trending move the next day. And that happens. What it does in that course, it populates this entire single print, because this was too emotional. It populates this but is not able to accept below the low, and that means the auction still wants to go higher. And second day what it does, creates more value. So the participants were forcing the auction to accept lower prices, and all of a sudden the other time frame comes in, takes it higher. Now where should they ideally take it? There is heavy balance here, so they should ideally take it above this, but they are not able to do so. When they are not able to do so, what it might do is it will rotate in this range, so makes a 3-day balance. Now when we go, if we merge all this, now this doesn't look like a complete balance, and you would start spotting anomalies, but this is not the what the auction is telling us, because from outside it is not at all like that. Just because we thought of merging it does not mean that the market will follow that. So next day this happens. Now this builds confidence. Okay, composite profile is the right most way of trading, because see, I merged this composite and next day the market traveled the entire composite, and this becomes a habit. So the next part, the trading mindset and all, we are going to discuss this, that how the habits form and how the people get attracted to things that are not existent. So now let's get into another nuance, which is mechanical references. Traders, being human, want markets to be orderly and easily understandable. But if you start with that expectation, then you are off on the wrong foot. This is what Jim Dalton says. That was what I was saying, that types of excess, that's what I discussed, that you confirmed a short term excess, then you confirmed a intermediate term excess, and the next day that was negated. So excess first day was confirmed with a tail, but that is a short term. The gap confirmed that is a intermediate term, because the gap was on the side of the fall, but then you get that covered, and that means that the excess is already negated. This tendency of the traders creates moves off the mechanical references. Daily, weekly, monthly highs or lows or close are mechanical references. Daily, weekly, monthly 50% retracement or half back is also a mechanical reference. Initial balance highs or lows, mechanical reference again. Now don't be surprised. VAL, VAH and POC are also mechanical if traded to the tick or to above or below. Now this is a tendency of most of the traders. The market opens, you would instantly see a tweet. Exactly rejected from the POC would be the tweet. Yes, it is. I would feel very sad. Why did the market do like this? If it is so exact, that means shorter term players are there. Longer term players do not like exactness. A longer term trader does not care what the market is doing and where the market is. He would come in at his desired location, his perception of value. He is not bothered to look at all this. If somebody is playing exactly to the POC or the VAL or the VA, that means their perspective is very short. They will just run away the moment they see profits or losses. They won't be able to move the auction. And what happens is it drives down. Like when it drives down, you are, oh, see, I caught it right at the edge. Now, when this was happening, it's very rare that you will be able to enter right here. You would be entering somewhere here and see what happened. previous day's range was this high, a day before was this much range, and what happened here? The range automatically contracted because they were all in a hurry to go down, but they don't have that capacity. They can't move the auction. Next day again the same thing happens. D period comes exactly to the POC. K period also exactly. What finally what happens? They try to push below the initial balance low but fail. So range again contracted further. And this is, see, don't even need explanation. This itself proves that all these guys who are playing mechanical are too weak to move the auction. When these guys are entering, that means the other time frame is not interested in trading on these days. But these days can provide very good opportunities intraday because you are almost confident that this will turn out to be a rotational day. You will get multiple rotations within. Second day what happens is opens, tries to push higher and creates a balance again here. Again a very contracted range. Now you get the first reference, a single print, and that means a time frame a bit higher than this. So this can be a shorter time frame which is trading for 2-3 days, has entered, pushes the auction down, and see the range extended automatically. The range is higher than this day and is trying to explore value. Now again the second day is not able to push through this and leads to a balance in this zone where they had not accepted in this day. But again what does that say? Again that DTF is in control. When this breaks with a spike, we want some reference that either the auction extends very nicely below or nicely above so that we get a trending move. Now what happens is it does it on the lower side. So it opens with a gap, is not able to push through this range, and then you get a nice trending move. And here your previous reference comes into play. Yes, we'll do that. Now this has started the trend. You have a single print again here that is closed just by a tick. Again, when it is closed just by a tick and not able to extend, that means again this move higher was by shorter term traders. They won't exist. They won't be able to move it. What happens? Instantly gets rejected, comes back and closes at the fairest price. When it's happening again, what you have, your references next day it would give again a trending move. Again that happens. So anything happening at the VAH, VL is all mechanical and short term. They won't be able to move the prices. Then 50% of the range also mechanical. Above, just above the high or low, like see here, just getting settled at the low does not serve the purpose. Also, if you see this, you split this getting exactly into the A period low, not a nice sign. That means day time frame is existent. Other time frame does not care about all this. And finally, what do you get here? A long liquidation break, a B profile. Next day is not able to go below and you get a single print here. When you are getting a single print again and building value, that means the auction wants to go higher. So first it is accepting this price, trying to push into this range. Yes, last 30 minutes is because see two reasons. One is all players stuck on the wrong foot are getting a forced exit because they have taken intraday leverages. The brokerage house is cutting off their positions. To get the clue of what the auction might do the next day, first thing is that we see where the auction is moving in the past. So on the daily it is moving down, then you expect that it might continue down, because if the weekly is down, daily is down, that then generally you expect a continuation until and unless you have got any failure sign. See, here you have got a failure sign. There is nothing here. There is a minor tail but below the IB and fails and gets back. So here what you are expecting is, if it's able to push above this, because see, this is the accepted area. If it's able to push above this, then you are, so depending on the open, and that's why I always keep on saying that predicting during the day is at least fine, but predicting the move for the next day might get hurt, because see, the trend is down, but what if it opens above this? It will try to push higher, then it's not going to stay down. But here we have got a open below this balance. Now here itself we have decided that it will try to push lower and we'll get a trend. So we got a trend, but at times we need to always look at the information which is generated, that there is a balance here. If it's opening above and giving a drive up, we don't want to short that. And see, that happens here. It has opened right above the point of control, tries to push lower, again tries to push lower, it's failing. When that is happening, the moment you get a single print, you don't want to fight with these guys. These are other time frame, they will screw us badly. And their first objective would be to go to this magnet, because this is a prominent POC, it will go to there. Now it goes there, even goes higher. Goes higher means, again, what do we want next day? Next day we want that it starts either accepting this price or directly opens above this and starts going further higher. And see, what it did is, it went there, your objective is still this fairest price. Now next day comes here and now you have got a failed auction. And you finally get your perceived price which you thought would come. Now auction failures, because there was a failure which we saw right now, so we should get into that as well. Auction failures occur in all time frames. Failed auction FA is widely misinterpreted, and we'll go into that reason. Ray Barros observed that if the auction breaks the initial balance by a single tick on one side and it does a range extension on another side, we have a failed auction. FA says that we will revisit those prices in 5 days, and if not revisited, it can act as a support or resistance for a considerable time. Auction failures can be of any importance reference. It simply means that an ongoing auction pushes above or below a reference and rejects to continue on the opposite side. Now that is the difference between, like, when we talk about auction failures, it does not necessarily be the FA as per what Ray Barros says. So we have to differentiate that. It's a very thin line. Now Ray Barros developed that theory of failed auction, and this is, anyone wanting to see can go to his site, the tradingsuccess.com, and he has made this. What is a failed auction? It's a single print at one end of the profile occurring after the initial balance that is followed by a range extension at the opposite end. Last night we saw the failed auction in the E period and the range extension in the J period. So it needs to fail one tick and then travel to the opposite side. So now let's see if that happened on the day which we were looking at. M period breaks the IB low, but is not able to travel on the opposite side. So even if because the market closed, so now you are looking at a continuation of the auction till this is protected. What you are looking is that it will go and break this, not because of the IB, because it's a failure. If it's a failure to accept this prices, if it's rejecting here, that means the balance rules is what Jim Dalton has made. The balance rules say that if an auction attempts to break past the balance, fails to move in that direction and enters back into balance, then there is a higher probability of the auction traveling to the other end of the balance. Earlier, Jim Dalton had developed 80% rule, and when he saw that there is much more information that the market is generating, and being rigid with rules is not what a trader can afford. Other part of the balance rule is that the auction breaks past the balance and accelerates on the side of the break and continues till it can find an opposite force. So in this case, what happened is it breaks here, is not able to stay below this range, and what it does the other side of the range. So this is much better because you get a trade with just this much stop loss and you have already determined your target to be somewhere here. Your first target is prominent POCA, your other target is going to the end of that balance. And the other balance rule, you get a balance. So you got a balance, breaks past that balance. So what we are considering, this much is the balance, breaks past that balance and accelerates. So here it is accelerating. So both the balance rule examples are already there here. That one is it fails and does the other side of the balance. The other is it breaks and accelerates. Now gap rules. If the market opens with a gap and the auction does not build value at least till previous day's close, chances are higher that in late afternoon it will auction in the direction of the gap. Now let us find a gap day. Okay. You have a gap up open. Now within A and B period only it should have come down and started building value here. If that doesn't happen, the gap is on the upside, it's a positive gap, the chances are higher that late afternoon it will go on the side of the gap, and which is higher. And see what happened, L period breaks higher. And a very simple rule to follow. Market gaps up, not able to push into previous day's range and create value at least till unchanged or the close of the previous day, there are high chances that the market will rally on the side of the gap. So if this was a gap down and not able to push into, suppose you get a gap down the next day, suppose you are getting a gap down here, market goes here, tries to push higher. If it's not able to go into this, the close is see so much higher. If it's not able to go there, even if it comes up here, the chances are that it will start falling in the later part of the day. Now here how to blend the context. You have gap rule into play. If it would have happened gap down, you have a strong close above the point of control, but at the same time you have the balance only here. So either it comes here and starts building value here in the spike, so you think that okay, this gap is not going to work, or it goes here. If it doesn't do both of the things, both the contexts are wrong. So it's not accepting this spike also and not accepting this value also, and that means your combined together everything is saying that late afternoon you are going to get a nice fall. So now I think what we'll do is we'll take a break and continue. Yes, spike, we can get done with the spike. Actually, now I didn't do spike rules differently because this is what we were discussing. Let me show. There was a nice example here itself. Okay, so market has spiked higher. Ideally the open should be outside the spike. If if it's breaking uh, above the spike, that means this break is accepted. Otherwise this break might be rejected because the auction is going into imbalance. The auction can right away come into balance, means it could start creating value here like this, and then it will decide what does it want to do. So it will create a value, create a point of control, and then decide either it will push higher or might push lower. But here what has happened, it is not able to, again the same thing, you have a spike, not able to create value into even unchained, and that means this spike which is created is true. The spike low is also protected, even this M period low is protected, and your major reference is still this. And when it's doing this behavior, you know that it's going to push higher. So it pushes higher, then it met with a opposite force, and see the close comes into the spike, and that means the next day the chances are high that at least you won't, in such cases you won't get a gap up open somewhere here. So you have time till the next day to again build up positions. Okay, now another example of spike. I think these days were like specially made to give examples. You get a spike directly open below the spike. That means this spike is true. So you have a gap, that too below the spike, confidence. You don't want to mess with this market. You don't want to try to fade this move. Okay, no, A period has gone this much. Let's buy it here. This price is too low. Don't try to assume that this price is too low, because no low is too low in this case. Till you meet with an opposite force. Opposite force is where, see, one time framing lower, and all of a sudden one time framing stops. That means that you might still get a lower move, but won't be this trending. See, it was trending, 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 trending. The trending stopped. Next day, what happens? The market gets confused. And that means there is someone here who is perceiving that these prices are not fair. Now somebody has started perceiving, so we can also start perceiving along with them. But before that, if we get into all that, would be suicidal. Cool. So now let's break and then we'll again continue with the question and answers, because see there is a lot more, like even 1 month won't be enough to explain market profile in its entirety. But I just wanted to go that okay, everybody knows, but some things which were like a confusion, I keep on watching what everyone is discussing, what people are talking. So just to clear that confusion, tried to share what I have learnt, and that's why just discuss only those parts. But otherwise it's like there is much more to it in market profile. So what we'll do is we'll do half an hour question answer after coming back, so that if any confusion is still there, we can finish that and then move further, right? So main site for the nuances part. Okay, so first question is a very general question from Vijay Pathak. What is FT71? FT71 is futures trader 71. He follows volume profile, not market profile, but a very good guy, a lot of experience, runs a prop shop in US, and many informative videos on his YouTube channel. So just search futures trader 71 and you will get it first in the Google results, and then you can have a look at his channel. And like every day he does a traders digest before the American market open. So it is just, see, it will be repetitive. There is nothing which is new. So even if I do like 1,000 webinars, I would be just changing the sentence here or there, because at times the price of Nifty currently would be different to the previous webinar. At times there will be a different behavior, but the basics won't ever change. So it will be like blabbering the same thing again and again, and that's why trading is a boring profession. And somebody who wants fancy should rather start gambling instead of trading, because I'm sure like when you start trading actively, there will be phases where you get damn bored, because there is no way to get any entertainment in this. Okay, the second question is it has a excess at the bottom as well. So now how actually it came in the Q&A section, so should have answered that time, because now I don't know whether he'll be able to spot it or not again, and I think he's not there as well. Okay, so let's move on. How do you define the extension handle? Extension handle, simply on the profile chart, you just need to see during the day there will be a time like this. See, the A period high is here, the B period high is here, C period crosses the A period high, but the D period low does not come to that point. So there is no other bar has traded at the A period high. So there is a blank area left there on the 30-minute bar. And when such a thing occurs, you call it either a single print, and most of the market profile softwares will automatically plot this. See, this is automatically plotted. Now this you can use in a smaller time frame as well. This can be happening on 5 minutes as well. So if you are a scalper, you can use a 5-minute chart and look for the same behavior. If you are a long-term player, you can look at it on a hourly chart, but as a thumb rule for market profile we need to use the 30-minute chart and always watch the 30-minute chart irrespective of the time frame that you are using. Yes, correct, it's a hidden gap. So consider like whenever a gap happens, suppose this is a gap. So you consider if the market was trading that day, this would be a single print all the way till here. Just because the market closed here and opened next day gap down, so we got this gap. But if it was continuously trading, because the auction is a continuous process till we don't get an excess to end that particular auction, and it is time independent of any time frame. The auction can go on for days to weeks to months. It is just that the exchange is opening and closing. The auction is not doing that. Now coming to excess, downside we generally have a rejection with a long buying tail as a rejection from any key reference area as a responsive activity. But on the upside, if we are at all time highs, new territory, we first create balance after imbalance, leave or break the balance to form one excess and huge selling tails not there often as initiative activity, that is 8950 6229. Yes, it what happens in the distribution phase, like let's go here itself. Generally what happens in the distribution phase is going on for a while. So I think on this we'll not be able to go. Let me take another chart. Yes, we can study that. Okay, now when the market is coming down here, let me delete this so that it the view becomes a bit more clear, so that we don't see any indicators. Now a pure price chart which everyone can see even on Google charts. No need to get into the complexity of value area and stuff. So we get into this. The auction was continuously coming down. Now, okay, so I'll have to delete this. Hiding doesn't work. Or let me see if I have a blank chart, then we'll take a. Data. Just a second. I use investor RT. Now you can, there is no need like investor RT. I use investor RT because I had been making like too many things on investor RT, and that's why it becomes easier for me to use it. Okay. So now we are here. The market was coming down. See, for a beginning, it is good to use AMI broker, but I would still suggest that at least move on to Ninja Trader, and that you will require in the initial phase, because you want to understand, like we were talking, that you will understand the graphic better. So once you develop that understanding, then you will automatically realize from these candlesticks that what is happening. So now here, like, see, that's what we are going to discuss, that how would you analyze it with just candlesticks. So here you get this huge move down and up, so a huge volatile day. When such a shakeout is created, generally we want that shakeout needs to be tested back, and that is not a rule of this is not a rule of market profile, but as per the demand and supply of volume spread analysis, when such huge volume is generated with a huge range, that's a shakeout or a stopping volume, because the trend is down, so, and the bar is positive after a huge move down, so that means it's a stopping volume, and generally it needs a test before it can decide to reverse. Now what happened is, it came down, and see, the volume is still not dropping. The volume needs to completely drop if it wants to create some accumulation in this zone, and volume needs to drop on a daily basis, but at the same time there should be accumulation. So what will happen, it will create a balance, or in other terms it will create a trading range where the volume keeps on dropping, the range keeps on contracting, and slowly everyone is losing hopes that this might not fall down, this might not fall down. So aggressive shorters are also staying out. They are not interested in selling anymore, and when the day time frame sellers are still taking advantage to sell, the longer term money is getting in slowly in this zone. Now my expectation when this happened was, when this broke and we saw this positive bar, I thought that this could at least mark a reversal into this gap, but that didn't happen. Now when it came here, again this was an important reference. Now when we go back, we were talking about balances. See, you have this balance, so again a very simple formula. You just mark this box and see where the prices are traded the highest. You get this as a reference, right? So it is trading below that, and even below this lower zone. So you want it to at least come back up, but on the other side you still have another balance, and that is this one, and you have the fair price somewhere in this zone. Now what is happening, it is trying to come into this balance, but again and again rejecting. So these are, now this is a daily chart. When you go to weekly, you might get the same, but when you go to 30 minutes, you might get even closer zones. So the idea of demand supply is like this. So you mark a zone, the nearest zone below your current trading price, and the nearest zone above your trading price. So that becomes your supply, this becomes your demand. Now see where it is going, it is coming into demand, but you have negative bars. That means if there is demand, you need positive bars. and with a bit higher volume. But here the volume is high and the bars are negative, and that means the supply is coming, but just something is resisting the price to go down. And when that is happening, you cannot just jump into a trade on the long side thinking that it might reverse. Like, see, after reversal we can easily find out, but when this was happening you can't just jump in. So let it form a balance. Now let me clear this and we'll zoom it. Now if you see, we were talking about balance. This is your selling bar. This 3 days are within this. So if you look at it as a visual, what you can see is you don't need to draw a composite profile, just visualize with because trading is an art. You can be artistic as much as possible, and you draw this. What do you get? You get a long liquidation profile with the fairest price being this. Next day what happens? We were discussing open above the fairest price and drive up can be a good reference. The time frame is daily. So what happened? The market rallies up. Now for me, this is a short-term behavior to reverse like this. I would not bet on overnight longs yet, though market is going up daily, but that does not mean that I start betting on overnight longs. So it went on, goes till here. Now it's not able to fill this gap. That means somebody who would have sold here, this is a time frame higher than this. So these guys buying are weaker than these guys who have sold. So what does it tell you? That the long term time frame is still in selling mode. So you are looking at opportunities to sell here when it's not able to fill the gap. Now obviously you are awaiting information, there is no confirmation, but still you are getting this bar is negative going into this and going into this range as well. And that means that the way it was, see, when it was going up very nicely, one time framing, and then all of a sudden stops. So this halt can be two things. Either it wants to continue higher, break out and continue higher, or it wants to retrace back. How much, that we don't know. That we'll keep on analyzing as we get the information. Now this cannot be anticipated that it would gap down, but because the long term trend is down, generally the gaps would come in the favor of the long term trend. Like, see, the trend had gone down here, this entire area is left as an excess. You get a huge gap, go back and test that balance and see none of the opens and closes are coming into this range now. So that means this is an excess. The auction which started from this Brexit lows till these highs is ended here with this excess. And once that is ended, we want to see what it can achieve. Now there is, yes, correct. So island reversals is your day time frame excess initially, and the second point is, now only thing in the island reversal is that you are looking it from outside, and that is the right thing to do. It's absolutely correct, because island reversals have been traded since long, and any theory that is formed cannot be wrong. The only advantage that we get here is that we have that fundamental logic working in our mind, that if we see an excess, that means it can be an end to this up auction. And if it's an end, that means that the confidence to carry a short position grows. And then as we get further information, we can also analyze what can happen. Suppose you consider this as an island reversal. When this engulfing happens, your candlestick analysis says that this must be some bullish pattern. But on profile, we are still saying that this is a long-term excess coming in, with a huge gap, accepting below this balance as well. You are developing a balance here, and that means that any retest even of this fair price is not a long yet, because we don't know how far this auction wants to go. So the only advantage above this uh, island reversal or candlestick pattern is this, that the concept of value gives us an added advantage, that the price is an advertising mechanism. It is advertising opportunities lower and higher, but we are looking at where the value is developing and where the other nuances are working. Like so somebody asked about the price action. Price action is what everyone is trading. To be successful, we need to trade something that everyone is not trading, and that's why we talked about those mechanical references, that if everyone is looking at the day high and day low, buy above a 3-day high, sell below a 3-day low, buy above a weekly high, sell below a weekly low, if everyone is doing as per that, then only thing that can happen is we can go and cry on social media that my stop loss was hunted by someone. Now, are they free? Are they jobless to hunt our stop loss, or are we trading 1,000 lots at a time that they care that okay, they will get a huge profit if they hunt our stop loss? Now, at least I am not trading 1,000 lots, so I don't know if anyone else is trading here. Then please bear with me. So the entire idea of a profile technique is that we will not look at just the price action. We will always look at the value developing with reference to the previous value. Again, the value is not independent on its own, because on its own it's just the current information. We need a prior information as well until we get a complete current information. Now, to invalidate an excess, do we need to wait till it balances around that excess or trades higher in excess, or can we anticipate early? See, I would always prefer anticipation, because as a trader we don't get paid to keep on waiting for information to come in. Now, what I would do here and what I had done here actually is I went positional short just at this break itself, because the other reason was that we have broken above the swing high and failed. So that was one reason. Second reason was we developed a 2-day balance and failed. Now I can get hurt badly. There is a chance that the market opens directly 100 points gap up. So at these points, what I do is I trade future shorts, plus I buy puts, plus I buy calls. So my future shorts, if at all there is a 100-point gap up, I would be suffering a loss of around 60 points instead of 100 points, because my puts will lose premium. I will suffer a loss of 100 points on the futures, whereas the calls would not get more than 60 points. So overall, I will still suffer a loss of 60 points. But on the other hand, what will happen is such places give you nice trade locations, because generally the falls will come in gap and your puts will directly go multiple, because most of the retail is the reason for buying the puts and calls both is the call is a hedge against my nifty future short, because it's a critical area. There are all chances that my position might get badly hurt. The reason to buy puts is that I always keep on buying puts no matter what. because suppose if you are investing in stocks, there is always an overnight risk of your stocks dropping 5 to 10% because these stocks don't have shame. They are not shy of us. They don't care who we are. They just fall. One negative news and we will be like we'll be completely gone. So and yesterday I tweeted about that as well. That's what I keep on doing is buy a two strike OTM put always, like always keep it, and do it with discipline, a fixed size. How that will help is that at times, like let's consider that in a year only 3 times your put comes into profit, but when in those 3 times when it will come into profit, it will be at least 5x. So 3 times you are making 15x. 5 and 5 you are getting that much, and on the losing side you are just losing your cost. So the accuracy doesn't matter. Yes, 2 straight OTM put, and like currently also keep in mind that just apply a bit, not too much of brains, just a bit of logic, that you should be able to see a breakdown level. Like currently the breakdown level seems to be 8,700. It's not going below that. So I chose the 8,700 strike price and it was trading at a comfortable price. So what I do is buy in 3 parts and try to get the cost down as much as I can. Yes, last day of expiry of any month, you buy the next month. And maybe it happens that suppose like I suppose if this was my first time I bought it in March, so I bought it on the expiry day for the March contract, and what if the market rallies 200 points, those puts are going to go to zero. So when that is happening, you try to evaluate in between that do you want to still average or get out of that strike or keep that, and your the second 2 parts you can then choose a strike higher as well, because now the market has already rallied, because you are not playing for 2-3 days, you are playing for the entire expiry. Yes, 200 points away at least, because see otherwise they will be so expensive that if they go to zero we are gone. Oh, no looking at IVs, no analysis, nothing. See, we have fund managers, we have prop shops, we have so many guys doing that. No, two strikes lower, 8,700, 8,600. So this time I have bought like 8,700 and 600. Because your 9,300 put will be so expensive. No, no, this I am talking just about put, because see here the put is naked. The call is not naked. The call is to protect this future shorts. In this case, the call is not naked, but your put will lose drastically because you don't have anything against it. Here you have future short, and that means your call is just a hedge to save you from the losses. Even if the call doubles or triples or even goes quadruple, you are not going to gain even a single penny, because by then your futures would have gone like in deep losses. And also the reason to buy the puts, naked puts, is that if you see all across, it's a general behavior. We don't need to apply any technique to it. Most of the people of India are long in stocks. You find any service guy who is doing a job, he would be putting his savings, a part of his savings, into stocks. He would either do it through SIP, either do it through mutual funds or whatever. So if he is purchasing mutual funds as a SIP, obviously mutual fund guys are purchasing the stock, and they can go long stock. So there are so many longs there in the stocks that whenever a fall comes, there is always a panic to rush and protect that fall. Because if the fall is coming, your portfolio is going down the drain, and you want to save it. To save it, you will run to buy puts, and when you run to buy puts, there is demand. When there is demand, the prices go higher. And to take advantage of that panic, if you are holding those puts, that is where you exit, because you know that you are already prepared for this panic and you wanted to take advantage of this panic. So see this case, surgical strike. When the market was trading here, nobody had thought in his wildest of dreams that it will fall this lower. Also, I had not thought, but what I had got is the puts. If I didn't have, obviously I am not going to buy here, because you can see that it is trading above this 2-day balance, but below this. So I would want it to go into this gap and fail to create a short. But because I'm already in my mindset that the long term trend has changed, and any moment we can get a very nice fall. Now this was a painful journey, though I drove down the journey till here. But when this was happening, it was so painful that you get the puts go like from 40, 50, they go to more than 150, and all of a sudden they are back to your cost. Because the time is passing, the premium is losing. So obviously there is a moment of fear, there is a moment of where your heartbeats can go up. But the strategy is not to panic and do it with discipline every time. See, if we do it randomly, then that means we are applying brains again. And what happens is market hates, we can't compete with the market. This is like, see, we are already competing. We are doing analysis and trying to go long and short futures every time and do trades based on our analysis. This is just a random idea to mitigate the losses, if any, in the futures if we are getting. So this is just a protection against your portfolio longs, as well as an investment, insurance kind of investment that you are betting on, that the premium you are paying throughout the year would be rewarded by a bonus. So a simple technique, that it's an insurance, and that's why I at times like tweet that bought the insurance puts. Now doing on the last day of expiry, playing anything, that means it's a strategy. You are playing that strike with a motive. Here there is no motive at all. So for that, I would not play lotteries like that. Because if I had to buy on the expiry, then I would look at what is happening and then only enter. Okay, now the other question is, auction failures can happen at any reference levels. Is there anything like this, auction failures are more important than others? Yes, obviously. The depends on your trading time frame, as well as the time frame in which the auction failures happen. Like this, let me zoom in. This is a failure above the swing high, and next day you get a gap. So it has stayed above the swing high, closed just above, next day you get a gap. This confirms a failure above this swing high. Now here also you have got a failure above the swing high. But this is less important because here your swing high was this. When this happened, this failure happened, your swing high was this. When this is happening, your swing high is this due to this retracement. Yes. So now we had gone till here that there is no confirmation yet that the trend has reversed, and now what is happening is it keeps on coming down, 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 down. Now see what is happening. One day it closes below the swing low. Next day it instantly reverses and closes into this, like see it has gone above this, it has gone above this balance as well. It is trying to capture this balance. The moment this is happening, you already have a sign, and see what had happened. The volume started dropping in this fall. Now a simple thing, you draw a line, your volume is dropping, but every time you won't get this clean move. It's this is dropping does not mean that every time it will happen ditto like this, because if it's happening ditto like this, becomes very easy to trade. And now unfortunately or fortunately, whatever we think, when the market was trading here, the 8100 call was trading just at 17 rupees, which is very rare. Like the expiry has just started and the call is trading at 17 rupees, which was very rare. So I thought let's risk it. Otherwise I'm very scared of buying calls, because the calls lose premium drastically because there is no interest. The people are already long portfolio, so they don't want to buy calls. They want to buy puts to protect, but because see, basically options are hedging mechanism. They are not trading mechanisms. So either you go long in futures here, considering that this, see, still it's an anticipation. It's not a confirmation. Your confirmation comes once this holds. Once we create value above this, because this is a reversal sign. Once accepted above this, it's a short term reversal. Still the long term is down because you have a nice, this thing is happening here, and your long term trend is down. Yes, you are continuously looking for any excess below this. Now this is an excess from outside, but when you go inside and see the daily profile, there is no clean excess. Where everything gets confirmed, yes, that's what I am saying, that there is no clean excess. Where this gets confirmed is here. See, you have a gap here, you have a balance, so entire balance is left with this gap. Yes, right. So you need to see where the value develops with respect to a previously established value, or if you have a single reference, like see here you had a single reference, you don't have value here, so you don't anticipate a long term reversal, but you can start anticipating a short term. And also what I did was, even with this, I just anticipated a intermediate term reversal. So the chances are that we go above this and fail. I was thinking in those lines that we will go above this and fail. Yes. gaps and extension handles are super indicators of change in sentiment. The moment a gap occurs, and that too on a reverse side, that means this thing which was going down has been uh, rejected, and there is counter activity taking place. Otherwise you won't get a gap, especially on the reverse side. On the ongoing side, if there is a gap, there is no problem. Now what I did is, instead of assuming a long term reversal here, because see, we still had a balance here, you still have the upper balance here, and not able to push through the fair price of that. So this gave me a sign. First I had thought of a reversal level somewhere between this, that if it crosses here, when we were trading in this range, the reversal level for long term was here. The moment it did this, instantly get the reversal level into this, because now you might miss the chance if you don't get your levels down. What happened is, it went into this. Now I kept the level as 8195, because that was when we plot this value, it was precisely coming at 8195, and that was also there was a HV and just below that. So I was still keeping a bit of leeway on the upper side, that if it's a trend change, it should show its real colors. It showed the colors but failed. Now it failed and I got disappointed that okay, maybe my level is not working. But the moment it gave this gap, okay, now no looking back. Till this gap is holding, the trend, long term trend has changed up. So the reversal started from here, confirm further here, and a final confirmation with this gap that the long term is also changed. Now what how do I define long term is, it might continue for 10 to 12 weeks from here. Now we are already 8 weeks are already done. So maybe that's a cycle that in 10 weeks it might exhaust, not a norm that it will exhaust. Now again what happened is, you can see an excess here. Yes, can happen. You can see an excess here. So what I thought is, see, we are still into a very important supply zone. We are just trading and creating value there, but the value is not within this area. See, it should have gone into this. So if it's not going into that, and see how the volume dropped, a positive bar, and all of a sudden the volume drops. And I thought that okay, this might be a dangerous situation and it might reverse. So here I thought it will change the trend. What happened is, it gave a false breakdown. The next day it rejected. The moment it's doing this, when this came here and going above that, is again a change. So what you are anticipating here is all gone. Your trend is still up with this bar, and the next day you get a gap and drive, again a gap and drive, and the trend continues. So basically, if somebody is trading on a swing basis, doesn't need to even go into the profiles, can estimate just from outside like this. But see, price action traders would be considering, let's see what the price action traders would be looking. They would first take this, break above this high, buy, break into this gap, buy, break above this high, buy. What we are looking at, marking this values, take this as a balance zone, take the price where all the bodies have traded, and consider that. So many times we are actually anticipating much earlier, and also by that we are defining the structure as well. I've already um, just a second. All the books on VSA are here. Let me send you a link. Not just VSA, but everything related to. Yes, yeah, yeah. That's the link. See, you can read those books on VSA. Take the logic of it. Don't try to over analyze stuff. There is no requirement. The market is very visual and very simple. It's just that, and that's why I thought that the mindset part is the first and foremost. Like after everything, you will feel that you know everything, but you still fail in the trade, because knowing everything is like, see, everyone gets a degree. You are going to a college, you answer the question papers, and you become a graduate. You can become a postgraduate, but everyone doesn't become a CEO or CMD of all companies, or everyone doesn't become an innovator, everyone doesn't become a scholar. That is as per individual capacity. There are many scholars who have not been to formal education but still know how to invent or how to discover some stuff. Yes, we can form a poor high in future. Okay, another thing is your excess gets confirmed post a gap or anything when you have a poor structure at the highs or lows. But poor structure coming at extremes also means that the sellers are exhausting. If the sellers add some strength, would they let it open here? They would directly make it open lower, or at least after the open they will push it down. But the sellers are exhausting, and when the sellers are exhausting, the market loves to go on the opposite side. I am a zero in GAN. And also, like while we were looking at that slide of nuances, and I think many would not be knowing, so responsive and initiative activities is only that it was formed for the daytime frame, that anything above the value area of the previous day is initiative if it's going up, and if it fails and breaks the IB and you get a counter auction, that means it's responsive activity. That somebody, the auction was trying to come down, 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 has broken the IB, but somebody responds to it, and that means basically it's the literal meaning of responsive versus initiative. Yes, now see divergences. Then I always start remembering that saying that the divergences can stay longer than we expect, or longer than we can stay solvent, and that we'll come to now, because delta divergence is the buzzword, and if anybody would have traded delta divergence currently, then would be in a deep trouble. Also, like, see, when that talk has come, let me show you one thing. Now this is market generated information. The McClellan oscillator is nothing but the number of advances versus the declines, and 19 and 39 period average of that. So here, see, from year to year, the McClellan oscillator has been declining. If somebody would sell here and keep on watching this every day, this is giving confidence that the market is not going to go up. And this was once upon a time, this was an obsession, that mo goes to 80 sell, mo comes down to minus 80 buy. This minus 80 buy worked, but minus 8 the plus 80 sell is not working. So see, what happens is, we'll discuss all that. That all is part of trading mindset, that how we get disturbed by things around. Okay, now let's go into order flow. So before going into order flow, what I'll do is make this a separate, stop this recording and start it back again. Yes. And